All right. Hey, thank you everyone for joining today and welcome to this edition of Lunch with GoalsGetter by Amova. Now, as you would have all noticed, we rebranded on the 1st of September, and that has meant fresh new colors across the GoalsGetter platform online. But it's more than just a new color palette. The rollout on the 1st of September also included a fresh streamlined process for onboarding clients and how they accept their KiwiSaver invitations from the advisor. So we're really happy with how that new process has been received and how it's addressed advisor feedback. So thank you for those of you involved in improving that. And if you haven't seen that part of the process and what the client sees when accepting invitations, we have demo videos available for you. So just reach out. In addition, we also have updated GoalsGetter KiwiSaver fund booklets and brochures. So those are available in soft copy on the Advisor Help Centre. If you'd like the link to that help centre, let me know. We're also happy to post you out hard copies as well. Now, a quick reminder that GoalsGetter, one of the value adds of GoalsGetter is that we have Mapua Wealth research reports available for all of the diversified funds on GoalsGetter. And if you don't already have a copy of these and you'd like them, please contact me and I'll get those out to you straight away. And finally, before I hand over to David, I'd like to thank you all for your continued support. September actually marked our biggest month ever of advised KiwiSaver inflows for GoalsGetter, so we couldn't have done it without you, and we're really happy with how everything is tracking. So thank you again. Now, it's my pleasure to host Pathfinder Asset Management and Harbour Asset Management today on this Lunch with GoalsGetter webinar, both of whom have funds available on GoalsGetter. So first up, we have David Lewis, Chief Investment Officer from Pathfinder. David joined Pathfinder earlier this year and is a seasoned investment professional with 25 years of experience across global credit and equity markets, including as former Deputy CIO at Milford Asset Management. He recently served as a research director at Anthropocene Fixed Income Institute, where he focused on Asia's energy transition and holds a master's in sustainability leadership from the University of Cambridge. So thank you very much for joining us today, David, and I will pass over to you from here.
Many thanks, George. Let me just get the sharing underway. Hopefully that's coming through. So, morena kia koutou, ngā mihi kia koutou mō whakahara ki tēnei hui tēnei rā. So, morning to everyone who has dialed in, and thank you for joining the call today. I'm going to talk, it might be a little bit less than 25 minutes or so. Touch wood, and welcome any questions throughout, which I think you can post to chat, and Hamish will share with me. Apologies, Hamish. George. So the first slide here I have is starting with the least important thing, and that in this context is myself. And you've heard a bit about my background from George. I've worked in markets for a long time, around 25 years. I love investing, love markets, and I love trying to grow wealth for clients, which I think is a hugely important function and a very heavy responsibility. But I wanted to mention a little bit around this slide, the reasons that I've joined Pathfinder. I've been here around 3 or 4 months now. As George mentioned, previously in New Zealand, he had worked around 8-9 years at Milford, finishing as the Deputy CIO and running the Diversified Income Fund, which is around a $4 billion fund, which I'm sure many of you are aware of. As much as that growing wealth is a hugely critical task, for me, I think we can do a bit more than that. We can try and make a positive impact on the world and try to set an example of what a business can look like that will serve the future decades and serve future generations well. We've got some big challenges in the world and the global economy. We have some pretty significant strains on the natural world. Many parts of our social communities under strain, both here and overseas. Climate change is a big example of that as a kind of positive feedback loop is unfortunately only going to get worse. So I believe over coming decades, we'll increasingly need companies and people to look to take a more sustainable approach to their ways of doing business. Now, of course, many businesses and many fund managers have been taking some good steps in this direction in the last few years, and that sort of ESG responsible investing landscape has completely changed from what it was 10 years ago, which I think is a great thing. But for me, Pathfinder is probably doing the best job here in New Zealand around trying to both create wealth and also have some positive impact on the world and on the investment ecosystem. And it's that kind of dual purpose, which is the key reason why I joined here. And putting up a slide like this, you're probably wondering a bit, what's at the other end of the spectrum? What's the most important thing? So to state the obvious a little bit, the most important thing for us is our clients. And here at Pathfinder, that means not only the clients that are investing with us, but also actually their kids, grandkids, future generations. One of the four principles in our business is to be good ancestors. So we want to be good ancestors to those future generations. Hopefully I can get the next slide. There. So the next one. So that's our mission at Pathfinder. We talk about duality, which is a sort of twin mission, and we think about both halves of this in equal importance. The first is to generate individual wealth, and the second element to that is to generate collective well-being, and we do that by investing ethically, which I'll talk about how we do that through the course of this presentation. We have three pillars upon which our ethical investing approach is built. The first is respecting people around human rights, healthy communities. The second is respecting our planet. And the third, respecting animals. And 4 steps towards how we develop that ethical investing approach. The first of these is our exclusions and the companies that we don't invest in, and I'll talk about that. The second is positive investing themes in the portfolio. So we think it's not enough to just exclude certain things. You need to try and tilt your portfolios in a positive direction around the businesses that will support the types of future outcomes I talked about at the start. The third step we have is around our stewardship, which is our advocacy for change in the industry and change at companies, and our engagement with companies on that. And the fourth piece, which is really important, is private assets and the way that we deploy private capital to try and support companies that are seeking to generate positive change in the private markets. We are obviously providing new capital to companies as opposed to sort of trading existing shares or bonds on a secondary market, which has a lower kind of impact element to it. So exclusions, I won't run through all of these. There are revenue thresholds and detail that applies to each of these. So this is kind of just a high level overview. Some of these are used at other KiwiSaver and managed fund providers in the industry, but in general, we sort of apply a higher threshold. So particularly around fossil fuels, animal testing, palm oil, in the middle column there, livestock export whaling, although they're quite small in terms of the number of companies that are exposed to those, very small. In fact, weapons in particular, obviously very topical in the last couple of years. And all of those are available on our website and our ethical investment policy, and feel free to get in touch with me if you'd like some more detail on them. The second step to how we try and invest ethically is by looking for better companies. So companies that are, in some way, shape or form, having some positive impacts or, positive influence on the world. And, the way that we think about this is through 5 themes that we established a couple of years ago. Those themes shown on this slide. So the first is healthy living, second, deglobalization, and someone asked me the other day around this and interpreted it as sort of anti-globalization, which is most certainly is not. we are an organisation that is very supportive of a capitalist economy and the things that can deliver. Deglobalisation is very much around sort of reshoring of manufacturing processes and establishing deeper integrity to supply chains and more robust supply chains, and obviously a theme that's been a key part of what's been happening in many economies in the last few years post-COVID. So that's what deglobalisation is about. Digitalisation, fairly obvious, that's a very, very significant theme, and increasingly through this year and the AI boom. Healthy planet, another theme, and social license, the last one. So, describe that a little bit as kind of three ethical themes around healthy living, healthy planet, social license, and then two sort of more market-oriented themes. But all of them, we're trying to find elements of both of the companies that we're investing in. A few examples now that I'm going to run through, quite briefly, just to give you a bit of a flavour of what is in the portfolios. So in terms of healthy living, we're an active investor in the bond program from Community Finance, which is a domestic social housing provider and network here in New Zealand, and we've invested in a number of different instruments for community housing providers that they have supported. Ryman Healthcare, obviously providing, living for seniors. Side is a water cleanliness business based in Australia. Next slide, a few examples around deglobalisation, and you can see, ranges in the technology industry, main freight, transport, and logistics. Digitalisation, there's obviously many companies that we could pull out here, but just a selection. Healthy planet. So Vestas is a European manufacturer and installer of wind turbines, obviously quite a controversial industry and has been a difficult industry in the last couple of years, but we still have a smallish exposure there. Long Road Energy, part of Infratil, solar developer, ABB in engineering, and Contact Energy in New Zealand, who, despite having a small footprint around the use of gas in their portfolio and contracts that they have with the Huntly coal plant, they are an energy company that we think is kind of contributing through the amount that they're investing in their renewable portfolio towards New Zealand's renewable future. So they are not entirely sort of fossil fuel free, and we have them as an exception to our exclusions, given some of the positive change that they're making around their renewable portfolio. The third key point to how we sort of support our ethical investing policy is around our stewardship, and this is a very important part of it. This is a way we think we can have a tiny voice in the ears of some of these companies and industry efforts, but still one of the ways that we can try and contribute positively. So obviously we're voting our holdings at annual AGM season, and taking a particular look at kind of climate social initiatives that are being put forward as shareholder votes. We're trying to collaborate as much as we can with other players in the responsible investment industry in New Zealand, and we do that through, for example, the Aotearoa New Zealand Stewardship Code. We're members of RIA. We're working with Climate Action 100 Plus around an engagement with a major New Zealand company, a collaborative engagement with other investors, institutional investors in New Zealand. But there are occasions where our engagement and our discussions with companies, it becomes clear that they're not changing any of the aspects that we might find troubling with them, and we look to try and establish so-called sort of SMART goals that are time-bound around companies and the issues that we're engaging on them with, and where they're not kind of meeting our hopes or expectations, we will divest them. So a particular focus, just to give you a flavour for it, around our engagement work at the moment is the situation in Gaza, whereby we are engaging with a series of US technology companies who have been highlighted by the UN as having some questionable links through to the operations of the Israeli Defence Force. So that's been a key piece of our ethical research in the last month or two. Very complex issues, obviously, given the interaction of the defence industry and the technology industry, which are, becoming increasingly intertwined. As technology becomes so crucial to the types of equipment that's deployed in modern warfare, if we think of drones, etc., in Ukraine as well. So we're trying to, focus our kind of fundamental research effort there around those companies actually on the ethical side of things, and trying to establish, are there links to Gaza for the likes of Amazon, Alphabet, Microsoft? Are they kind of over what we consider as a red line in terms of our ethical policy? And we're engaging with those companies and reaching out to them and trying to ask for clarification on the types of activities they're involved in and the way they're discharging their standard terms and conditions, whether they have any specific carve-outs for what the products they're selling there. Happy to take any questions on that. It's still work in progress, so no sort of conclusions as to where we'll land on those individual companies in that sense. Private assets, apologies, I mentioned was a really key part of our intention to try and have some positive influence with our portfolios. I've mentioned community finance already. We're also investing in Lodestone, which is a large-scale solar developer in New Zealand. Woolaid, which is trying to develop sustainable plasters. Women's Livelihood Bonds is an international fixed income program that we invest in. They're funding women's enterprises across developing markets and supporting around 2.6 million people through those. It's kind of blended finance, so taking money from governments and philanthropic sources to provide what we call sort of first loss capital in microfinance structures. So we have some support, the bonds that we're providing kind of sit behind that philanthropic and government capital, and has a layer of capital that supports it. So those bonds we've been investing in for a couple of years and have been providing pretty solid sort of 5 to 6% returns. Alongside, very, very meaningful on the ground impact for some of the world's, kind of least advantaged populations, and focused entirely on women. A little bit on investment process, and then hopefully we've got a bit of time for questions. So this focuses on our equity investment process. In fixed income, we manage the domestic fixed income in-house, and we use a third-party impact manager for our international bonds, aside from that Women's Livelihood Bond I just mentioned, which we invest in directly. So our international fixed income in the KiwiSaver portfolios is run by an impact subsidiary of MetLife, the US life insurance fund. But focusing on the equity construction process, so we essentially, after applying our exclusions, come to a trimmed universe of around 1,200 companies, and we have a sort of long-standing quant filtering process that looks at a range of both financial as well as sustainability metrics to sort of filter that down to much tighter, what we call sort of watch lists of 300 or 400 stocks. And then it's fundamental research from our team and portfolio construction from our portfolio manager through to the selection of the final portfolios, which in global equities is typically sort of 150 to 200 stocks. In our Trans-Tasman equity portfolio, more concentrated at 40 to 50 stocks. We typically have a fairly low turnover approach. Long only portfolios. We don't use derivatives to augment the overall market positioning, and we try and make sure that the portfolios are kind of leaning towards the positive themes that I've talked about earlier. And this gives you a bit of a flavour. The numbers here are a couple of months old, but it gives you a bit of a flavour for some of the kind of positive themes and how we position those within the portfolios. So there are, the bulk of that pie chart there is 78% is, things that, may not specifically align with one of those more targeted themes, but they're all kind of caught within our exclusion policy. So all, valid for investment from that perspective. And we try and have that tilt to the portfolios around things like renewables, water, green bonds, and other themes. Last couple of slides here now is just to quickly highlight the fund suite. So we've recently, a few months back, launched the KiwiSaver High Growth Fund. To now sort of round out our KiwiSaver suite for now. The only category we don't have here is moderate. The other three funds were launched back in 2019. Recent performance has been a bit more difficult through this year. There are a couple of reasons for that. Part of it relates to the ethical mandate in some of the sectors that we're not exposed to, such as defence. Part of it, if we look at the performance versus benchmark, relates to some of the gaps we have on the currency side, in that the hedge ratio within our funds is slightly different to the benchmark. So that's essentially kind of a bit of noise that always impacts shorter term numbers, but in the long term, that currency element will not be there. And part of it is we have not done as good a job as we would have liked to in the funds in terms of the core stock picking and the core risk management. In the long term, we're very happy with the returns across these funds, and if you look back since inception, the balanced conservative growth funds and all compare well, we think, versus the peer group, and reasonably well versus our own benchmarks. But did want to acknowledge that the more recent performance is short of where we'd want it to be, and we are looking at continual sort of enhancements to the process and the team to try and support better outcomes around returns for our clients. The managed fund suite, I won't run through all of these, but we have a property fund, a water fund, green bond fund, as well as kind of more core products around Trans-Tasman, ethical, and the global equity fund, global responsibility fund. So that is almost it. A little bit of recognition there on the second last slide. So we've won the Mindful Money Award for Best Ethical Investor. I think it's 5 years running, or before my time, so I can't take any credit for that personally. And that brings me to the end of the slides. So the time is just going off, and hopefully that gives us a good few minutes for questions.
Great, thank you, David. Great presentation. And a couple of questions have filtered through. So the first one was how live are these discussions and company positions you mentioned earlier, and what is Pathfinder's position on New Zealand's government's, the NZ government's position in regard to us not recognising Palestine yet? And has this resulted in any changes to your actual holdings? So if you'd like to elaborate on any of that, that would be great.
Yeah, thanks, George, and apologies again. I had your name mixed up with Hamish at the start. But so a couple of questions there. Has it resulted to any changes in our actual holdings? So the most recent sort of period of engagement and research around this has not at this point. Earlier, I think it was last year, we had sold Volvo. due to its involvement with provision of machinery to the Israeli Defence Force. So there have been changes in the past around companies we've excluded due to the nature of their. Sorry, it was Caterpillar last year, forgive me. So there have been changes before, but under the current period of engagement and the current issues that we're looking at, which were highlighted in a report from an independent expert appointed by the UN. It's called the UN Special Rapporteur. We haven't made any portfolio changes from that, but that's kind of speaks to the way that we would engage. And I had that slide there that referred to, kind of engagement. And then if we're not reaching a level of comfort that the companies are aligned with our ethical policy, that's when we might look to divest. So it's a kind of live discussion around. There's around half a dozen technology companies that we're sort of looking at closely, and the time frame that we're sort of have in mind around when we might have clarity on whether they do breach the policy is kind of by year end. So we wrote a blog on that maybe 6-8 weeks ago. So it's kind of a live process. There may be changes to the portfolio, but none from this particular episode. In terms of do we have a position as a business on the New Zealand government's position? No, I mean, we don't kind of take positions as a business on that. My personal perspective, I guess, and speaking solely for myself, it's a hugely complicated situation in the Middle East and hugely complicated political situation. I think anything that external third-party governments can do to try and support, move an effort towards a two-state solution is positive. But it's we're looking most closely from a portfolio perspective on the companies that are active in that area and active in their relationship with the Israeli Defence Force.
Great, thank you, David. And there was another question that came through. Any thoughts on having a cash fund available specifically for the first home buyers market in the foreseeable future?
No, great question. Yeah, in the couple of months I've been here, I haven't had discussions around that, so I'm not aware of any plans to have a cash fund. But certainly, always keen to hear from our stakeholders and customers, including advisors that are working on behalf of end clients, if there's a particular gap in the fund suite. So, we'll take that note, and we'll follow up with George as to any thoughts on how deep that demand might be.
Great, thanks. And final question. So given the strong markets over the past year, have there been any strategic changes that you've made specifically to the Pathfinder Ethical Growth Fund available through GoalsGetter that you'd like advisors to be aware of?
We're very active in terms of the asset allocation within the fund. So, we're looking to try and position tactically through the year, sort of. It's not day-to-day tactical asset allocation, but some of those certain changes are certainly moving around on a sort of week-to-week, fortnightly, certainly monthly basis. So we have been actively managing the amount of equity market exposure and the types, the kind of beta, the riskiness of the companies within the equity portfolio there in particular, as well as actively managing the small fixed income and duration exposure within that fund. Most recently, of note, we've kind of been closing the size of some of the positions we had in some of the Mag 7, where a couple of those we had been underweight. And that had been something that had dragged on portfolios a little bit. So we're kind of taking steps in the last month or two to reduce the size of some of those positions, just as a sort of risk mitigant within the portfolios. But overall, we haven't kind of significantly changed the risk settings within the fund. We haven't kind of significantly de-risked, despite the very, very sort of strong run for markets. That fund is really for longer term investors, 7 years plus, I think. So, yeah, we will manage those positions, but it's not going to kind of move from, an 80% to a 60% equity allocation. Sorry, George, I know you're
Okay.
probably watching the time.
No, that's perfect. We're right on time. Thank you very much, David. Hey, thanks for your time and for the great presentation. I'll let you get back to it, and I'm now going to introduce Hamish Pepper from Harbour Asset Management. So Hamish is the head of multi-asset and global investments at Harbour. Hamish joined Harbour in 2019, and he leads research and strategy across fixed income and currency markets within his role. Now, some of his prior roles include Barclays Investment Bank in Singapore and London, and the Reserve Bank of New Zealand. Hamish brings a deep global expertise in foreign exchange and emerging markets strategy. So, looking forward to hearing from Hamish today on what he's got to say. So, over to you, Hamish. I'll let you share your slides when you're ready. Thank you.
Yeah, thanks, George. And kia ora koutou, everybody. Yeah, look, I'm new to this role as head of multi-asset and global investments, and so I think with that I can probably provide maybe just a bit of a sort of a 30,000 foot view in terms of the active growth fund that's sitting on the GoalsGetter platform. I'll just pull up my presentation so we've got something to look at while we're talking here. But the long and the short of it is, if I look at performance from that fund, in an absolute sense, not too bad. They are positive returns and they are relatively sizable. But I think when we look at it on a relative basis, perhaps similar to what David was alluding to earlier, we're not that happy being behind benchmark. And so with that in mind, we are making some changes to address that. One of the things we're looking at is if we think about where that underperformance has been coming from for that fund, it's been from the global equity managers that we've chosen. So there's a lot of thought going into whether we broaden that out into a larger suite, and also in some of the Australasian equity exposure that we've taken as well, in terms of some of the concentration risk that perhaps we underestimated initially has now been something that has also contributed to that underperformance. So look, I want to just acknowledge that and say that we are doing things in recognition of it, and we want to fix that. And hopefully when I speak to you again, we have sort of a more positive story to tell on the relative performance side. But firstly, before I say too much, I should, I'm not going to ask you to read this, but so I'll talk you through the main point. Look, what I'm saying today, it's obviously not personalized financial advice to anyone. That's your job, not mine. So it's for general information only, the things that I want to talk about today. And so in terms of what I do want to cover in the next half an hour, and I'll be shorter than that, I hope, is I want to kind of lift the hood in terms of what we think is going on in global equities, what we think is going on in the global economy, but then really bring it home to what we're doing in multi-asset portfolios, because the Active Growth Fund is just one multi-asset portfolio that we manage. It's the one that's most visible because it's available to a broad audience that includes advisors and retail clients. But within Harbour, we are managing wholesale multi-asset mandates as well. And what we do with many of those is apply the same active tactical asset allocation tilts that we would to the Active Growth Fund. And so I want to sort of go through some of our thinking in terms of what those tilts are, and hopefully it picks up on perhaps the question that David had towards the end there about, over the past year, what has our assessment been of this, particularly strong rally, for example, in global equities. So we'll start with the global equity piece, broaden it into the global economy, and then we'll finish with what we're doing in portfolios. Please ask questions along the way. George, I'm happy to be interrupted, so if you'd like to do that, go for it. Otherwise, we'll make sure to leave time at the end. So look, you will know this well. It is global equities that have continued to dominate returns in multi-asset portfolios. This is the last 4 years. The 3 of the last 4, the most obvious set of bars here is on the far left, which shows you that over the last 3 years, you've had global equities return somewhere between 15 and 20% in round numbers in each of those years. And really, the only other asset class that got close through those 3 years was New Zealand equities last year, but even then, it was only a touch over 10%. So that's the world we've been living in, that if you haven't had global equities in your portfolio, then you really have missed out to a degree. Bonds have had a tough time because of the sort of round trip that we're having in terms of yields pushing a lot higher through 22 into 23 and now coming off last year and into this year. And so that's meant that those returns have not been helped by any kind of capital gain. One thing to note, which I think is interesting, is this rally in equities has been characterized as a growth led rally, led by growth stocks, where perhaps most of their earnings sit in the future. That's really only a story for the US. If you look at the world index without the US in it, it's actually been value companies that have been outperforming. That's the dark line on the chart here. If it's moving lower, it's value companies outperforming. If it's moving higher, it's growth. So that's one thing just to note. And so we've seen it, for example, in a manager that we have a relationship with, not unfortunately in the active growth fund, but in the BNZ portfolios that we manage, including the KiwiSaver. But in the active component there, we have a value manager who has done exceptionally well over the past year and speaks to this dynamic which this slide shows. The other thing that is clear here is within the US part of the story, it really has been a concentrated rally in global equities. It's been the Magnificent Seven. It's been the AI story pretty much since ChatGPT was launched towards the end of 2022. And I think that's meant that some of the active and many of the active global equity managers have really struggled to keep up with the benchmark returns because of the concentrated nature of this move that's happened over the last 2 or 3 years. So put really simply, if you haven't had those Magnificent Seven in the portfolio at a benchmark weight, then it's been very, very difficult for you to add value over and above the index. So a bit of an unusual time. So let's take sort of a step back in terms of how we're viewing the market at the moment, how we think about global equities. Look, yes, they are expensive. This is price to earnings ratios over the last 20 years, where the dark diamond, blue diamond, is where we are currently. The bright blue dot is the median. Then you've got an interquartile range, 25% to 75%, and then a max and min. In fact, the error bars, I think, are 10th to 90th percentiles. But essentially, they represent the range with which those PE ratios have moved over the last 20 years. And in the case of the US, we just simply are at really, really extremely elevated levels where US equities on this basis are screening as extremely expensive. And there is a dynamic for which that sort of pervades into the other parts of the world as well. So we're definitely cognizant and acknowledge that on this basis, the asset class looks expensive. But when we look at some of the ways in which any asset, but particularly global equities, can remain expensive, that's where we start to think there are some reasons why it can continue. So one is that positioning. If we look at our measure, which is flows into global equities, and we normalize it using a Z score, so it's comparable over history. Yes, we've probably come out of the buy zone where positioning was very light in terms of our read. We are not into what we're describing as a sell zone where there is such crowded positioning such that the market has become vulnerable to a pullback. So we're in maybe a bit of a Goldilocks zone at the moment where positioning is not yet extreme or extended. And I think you're starting to hear more and more stories of where perhaps there could be some building momentum for global equities over the remainder of the year as more and more investors get pulled into this equity market rally. It really has been one that institutional investors haven't taken a large part in. It's been more retail-led up until quite recently. The other thing is that, in many ways, these companies are delivering. So this is earnings momentum. In the case of the dark line, it is the forward earnings and the change in those that are expected over the coming year. And what we're seeing is generally those earnings revisions are moving upwards. And we're seeing net earnings revisions in terms of the number of companies that are revising higher expected earnings versus those that are revising lower. That number is still quite positive relative to history. So that's the lighter blue line. So the long and the short of it is that companies are delivering on expectations and in fact beating those expectations, which justifies to some degree the high multiples that are being paid to gain exposure to these companies. So that comes back to, yes, companies are expensive globally and in the US in particular, but we're actually dealing with companies which on an aggregate are performing really well. So I suppose the piece that is left here to a degree is, can the global economy kind of disrupt the apple cart here? That while yes, earnings momentum may be strong for now, it could perhaps weaken, and that could be a catalyst through which equities pull back, and particularly global equities. Well, look, the short answer before I begin here is that we just don't see that. We don't think the global economy is set up that way, and so I'll show you a few slides to support the view. So we're not going to argue that the world is definitely a much more uncertain place, and obviously Trump has a lot to do with that. There's various indices you can use. This one looks at the amount of time words that are associated with uncertainty are appearing from the quarterly Economist Intelligence Unit country reports. So they basically have reports for 143 countries, and they count the number of times words of either uncertainty itself or any variant are appearing in those reports. So uncertainty is high, no doubt about it. But what's happening is the uncertainty is not translating into economic activity as you would normally expect. You would normally expect, in an uncertain environment, firms would delay investment, households would delay consumption, that would pull down economic activity. And so if you take just the US, for example, I think where forecasters became the most negative was after Liberation Day. Trump standing there with his placard, various tariffs for each of the trading partners at just astronomically high levels. That was where really there was a view emerging that the US would struggle to grow much at all this year. And so you saw this come through in the consensus forecast that I'm showing you for the year. We've now come all the way back to really expecting only a modest slowing of US growth this year. We grew around about 2.5% last year in the US. Looks like this year it might be more like 1.5%. It's a slowdown, but it's by no means disastrous. Now, the other dynamic, which is helpful here for the US economy, and it has implications more broadly, is that because the US Federal Reserve have a dual mandate, they care not just about price stability and keeping inflation in the long term around 2%, they also care very much about maximum employment. And that's one of the parts of the mandate that is being tested more than the other at the moment. Inflation is high, but it's not out of control and it's not increasing, whereas the labour market is deteriorating notably. We've seen that in recent non-farm payroll numbers. We've seen it in other indicators of the labour market in the US. Obviously, we're yet to receive September numbers given the government shutdown, but we would expect them, once they are released, to show a similar story. And so the market's cottoned onto that and priced in more easing from the Federal Reserve over the next 1 to 2 years. We're now looking at more than 100 basis points of rate cuts from the Federal Reserve. And that's quite a shift from where we were, say, 3 or 4 months ago, where there was this residual concern about the tariffs and their implication for inflation, which may mean, at the time, was thought to have meant that the Fed just simply couldn't provide as much support to the US economy as perhaps the labour market would justify. The narrative now is very much that because we haven't seen so much of that pass through from tariffs into inflation, and the labour market has deteriorated more significantly than expected, then the Fed is very much back in play as a supporter of financial markets, including equity markets. Now, at this point, somebody usually points out that that's not all of the story when it comes to the transmission of US interest rates into the economy and into financial markets. There's, of course, the longer end of the yield curve, which has been moved a lot by some of the policies that Trump and the administration have introduced. So most notably is the extension of his 2017 tax cuts and the fact that they are not completely funded by reductions in spending, which leaves, all else equal, the bond market to absorb that additional issuance as the government looks to fund that shortfall. So as that's happened, generally term premia have lifted. That's sort of the compensation that investors are requiring to buy those longer dated bonds. So that's lifted up from being, quite deeply negative 4 or 5 years ago to now something that's getting closer to an average level of 80 basis points. We're not quite there, but at the 10-year term, we'd estimate that's something around 50 basis points now. But the other dynamic has been for people to think more carefully about what that tariff revenue is going to do to that fiscal situation, that tariff revenue is actually going to be quite a useful contributor to filling the shortfall between the extension of the tax cuts and the less than offsetting reduction in spending. When we think about the tariff revenue, perhaps there's a decent chunk of that shortfall which is going to be filled via that channel. So another reason why perhaps you're not seeing longer dated yields in the US push up meaningfully higher and towards the 5% level. It's actually been the opposite dynamic. We're converging more on 4. Now, just quickly on kind of some of the bigger other economies in the world, obviously China, the second largest. China has had a pretty good year, really, relative to expectations at least, where, again, in that earlier part of the year around Liberation Day, you had the 2 largest economies in the world going toe for toe on tariffs, both setting tariffs at that time, at least, that were above 100%. That was essentially committing themselves to a trajectory that would cease trade between the two altogether. Now, we've come a long way back from that. And as that has happened, and we've realized that perhaps tariffs are not the thing that has such a large impact on Chinese economic activity, we've realized that China's actually been growing above the 5% target. This is a monthly GDP estimate that Bloomberg produce out of more real-time data rather than waiting for the quarterly numbers. And we've been tracking, according to this estimate, above 5% for the year to date and meaningfully above in the earlier part of the year. So that's helpful from a global economic point of view. When it all comes together, if you look at something like the IMF forecasts for global growth over the coming couple of years, you do have a slowdown, but it's very, very moderate. You're talking about the global economy growing maybe 3% rather than 3.5%. This is nothing like, you can see the global financial crisis, the small blip. COVID was obviously very exceptional because it was proper sort of shutdown. But we're a long, long way from those kind of moments. So this is very much a soft landing from a global economic point of view. Now, just to say a couple of things about New Zealand here. On the one hand, you would say there's a real parallel in terms of we've got the US Federal Reserve coming into play because of the labour market weakness. You could say, well, the Reserve Bank of New Zealand has come into play most recently because of broad economic weakness. We saw a fairly sizable contraction in Q2 GDP when those numbers came out over the past month. And then we saw a reaction to that in the August monetary policy statement in terms of a lowering of the forecast OCR path. Now, just to be clear, the way that the RBNZ were thinking about that GDP number, because they didn't actually have it at the time, was that they have a real-time measure of where they felt Q2 GDP was going to be based on survey data mainly, but other higher frequency indicators. That was telling them that the economy was in contraction and that they needed to do more. And so we saw a reaction to that in the August MPS. You would remember that 2 of the 6 Monetary Policy Committee members actually voted to cut the OCR by 50 basis points. 4 said 25, and so obviously that was the decision. But there was a very clear intent there to send a quite dovish signal, a more urgent signal that there was more work to be done. And of course, you can see it here in the forecast, as I mentioned. You're looking at a low now in the forecast, which is about 2.5%, whereas for a long time, the RBNZ weren't contemplating seriously that they would have to lower the OCR through 3. Now, we'll hear from them tomorrow at their October Monetary Policy Review. Our base case is they cut by 50 here. We had the QSBO this morning, Quarterly Survey of Business Opinion from the New Zealand Institute of Economic Research. Very weak picture there. We had expected at least firms, when they were asked about their activity on a forward-looking basis, to be much more positive. And they simply aren't. They are more positive than when they look backwards. But when they look backwards, this is the kind of picture that you're seeing. I'm going to skip a slide and we'll come back to the export sector. This is the kind of picture that firms are reflecting in these surveys, which is, this is an output gap. What it is an estimate of where the economy is relative to its potential, what it can do. And what it says, according to the RBNZ estimates, is that our economy is operating about 2% below where it can from a potential point of view. So 2% below where you start to generate inflation, which is unwelcome. So we've got that much gap to fill or hole to fill, so to speak. And it's starting to look a bit similar to what we saw through the global financial crisis. So this is a large amount of spare capacity. We're seeing it through lots of things. The labour market is perhaps the most obvious. Large amounts of job loss, probably 35 to 40,000 jobs lost since the peak. We've seen the unemployment rate push up through 5%. And I think what we're getting from the QSBO this morning is a signal that this spare capacity is largely remaining in the economy, at least for the third quarter, and that the central bank, the RBNZ, does need to do some more to support this recovery and to ensure that inflation, which is its only mandate, doesn't undershoot the 2% inflation target that it has. So look, I think where we see all of this washing out is because of this greater appetite for the RBNZ to lower the OCR and to lower interest rates. And of course, we've seen mortgage rates move lower over the last week or so. We do think this will deliver a recovery for New Zealand, and that recovery will quicken and become more widespread next year, we think. And so part of the conclusion that I'll come to in a moment is that we do like starting to step into New Zealand equity exposure more than we have done at any other point this cycle. But just to add one more driver, I'll just come back one. So obviously we've got the lower interest rate dynamic feeding into a broader economic recovery, but we do have a really strong starting point for our export sector. So part of it is related to that China story I told. Part of it is a global supply dynamic, but where it's washing out is that for both the dairy and the sort of sheep and beef sectors, they're enjoying really, really good prices for their exports and continued demand. So if we think about just the dairy sector, they're looking at record high payouts, which is translating chart on the left there. The dark line is showing you record high annual revenue. And then they've had Fonterra selling their consumer business, which should result in a capital return, which is tax-free in the first half of next year, which we estimate to be somewhere in the region of $300,000 to $400,000 paid to each, on average, each Fonterra shareholder. So another way in which that external sector will have money to spend and to help that economic recovery through next year. So let me bring it all together just in the last couple of minutes, and I'll try and still leave some time. What are we doing right now? We are overweight equities, both global and Australasian, where the Australasian piece is really skewed towards New Zealand when I think about that. And the reasons I hope are clearer now, as opposed to if I just started with this chart. We're taking that money out of bonds, I think, like we've been describing. the RBNZ is now well priced by markets to deliver further easing and to get the OCR down towards that sort of 2.25% level. So not a lot of capital gain left there would be our view. And you've got running yield in those funds, at least the funds we have, that sits around what's hardly 4% at the moment. So just the sort of investment case for domestic fixed interest is not what it was. And so that's a natural place for us to take cash from. We're also underweight cash, happy to run cash balances a little lower. And then the other dynamic we have is we are overweight the New Zealand dollar. It's largely a story about US dollar weakness. We think that has further to run. A lot of what Trump is doing is questioning the US dollar's place as a reserve currency. We want to be, I think, on that. And we do think over the long term, the New Zealand dollar is undervalued versus the US dollar. Chart you're seeing there is a sort of a quantitative signal we use for global, and there's a typo in global, sorry about that. But that's our global equity model signal, for which positioning is, and some of the charts I've shown feed into that. But that's still telling us that, yes, you don't want to be having a big weight in your overweight to global equities, but it's not a sell signal, and it's something more positive than neutral. So cool. Let me stop there. I'll pass it back to you, George, and see if we've got any questions.
Great, thank you, Hamish. Yes, we did have a couple of good questions come through. There was one on global interest rates, inflation trends, and how you think that relates to the New Zealand market, but over the next sort of 18 months. But I think you've really addressed that quite well already, but feel free to elaborate on it if you'd like. In the meantime, how is Harbour integrating climate transition risk into portfolio construction at the moment?
Yeah, I was taken by David's slide of these sort of big, long, sort of structural trends that are occurring in markets. So I think if you were to talk to our equity team, they would really place a high weight on some of those in terms of, what does that transition, the carbon transition, the electrification, what does it mean for companies? In Australasia, who are the winners and losers? That's very much a core part of the way in which they're making decisions in those portfolios. And I think it extends to our global managers as well. So the energy transition is a key pillar, I suppose, of the way in which you're reducing your universe, I suppose, is the way to think about it. I quite like David's chart where it was sort of, you're starting with the whole universe and then you bring it down like a cone. That would be the way that our equity team are managing it. We want exposure to these big structural themes. Within those buckets, there's then going to be companies that we think are perhaps better placed than others to benefit within that.
Great, thank you. And another question that's come through, so it's from any point of view that you'd like, what's one behavior change that could make the biggest difference to long-term KiwiSaver outcomes in New Zealand? Would you like to share an opinion on that?
Take more risk. I think many people will look back and maybe looking back right now and say, I should have had more risk. Yep. I should have had a portfolio that was perhaps skewed more to equities generally, perhaps skewed more to global equities. And why are they saying that? They might be saying that one reason is they're simply living longer and earning money for longer. And then I think the other part of it is, the requirements, and this is, much more the participant space than it is mine, but the requirements once you enter into retirement are growing all the time in terms of cost of living. We've all got the stories around insurance and council rates and so on. Food prices. I've talked a lot about what inflation has been doing in aggregate, but it hides this story, which is this continued pressure on cost of living. And I think that's part of the maths, which people are perhaps reassessing.
Great, thanks. And any concerns regarding AI-related investment bubbles in the next year or two?
Yeah, I think it's the big question that continues to be asked is, when you look at the amount of money that's been spent, particularly in the US, in terms of AI related investment. Like, will the return on that investment come, and will it come quickly enough to justify how large some of those numbers are? I think for now, we are still in this early stage of both deployment, but then sort of acceptance and use of AI. I mean, we're probably all experiencing it, right? I mean, Harbour, we've gone through like a really, really steep sort of adoption phase. You know, we're now, most of the company are using Copilot, and Copilot's got this ChatGPT 5, you know, kind of underlay, which is fantastic. So I think the jury is still out, but we would say the momentum still seems to be there for, you know, this investment to be justified. But it's, you know, it's got to be the one of the top three things that you are asking if you've got, particularly like we do, an overweight to global equities.
Fantastic. All right. Hey, thank you very much, Hamish. Well, that's all we've got time for today. So I will thank you for the great presentation, and I'll just close off and let everyone get back to it. So, hey, thank you everyone for your attendance today. It was a really good turnout, and we appreciate your time. And special thanks to both David and Hamish for those quality presentations today. Appreciate you taking time out of your busy days to come and present to all the GoalsGetter advisors online here.
Thanks very much, everybody.
Thanks, Hamish. And our next webinar and our final webinar for the year will be in November. So we're going to be hosting Milford and Salt at that webinar. So invites will be sent for that over the coming weeks, and we look forward to seeing you there. So for now, that's everything. Have a great rest of the week, and look forward to seeing you next time. Thanks all.